in this explainer, we're going to break down what really happened, dig into the forces that caused it, and explore what it all means for the future.
But before we even why, you have to see the sheer scale of this thing. This wasn't just some minor dip. This was a financial earthquake that vaporized trillions in value in just a matter of weeks.
Think about this. Just a few months from its all-time high, Bitcoin, which is really the bellwether for the entire market, just plummeted. It dropped by more than half. A staggering 52% collapse. And this wasn't just people panic selling. Oh no. This was a cascade of forced liquidations. Over just 6 days, the market got slammed with $6.6 billion in forced sell-offs. That's more than $1 billion a day getting automatically dumped, which just pushed prices down even faster. A drop this big, this fast, it's almost never just one thing. It was a whole combination of forces, all colliding at the same time to create an absolute meltdown. So what were those forces? Well, you'll hear a lot of analysts talk about a perfect storm of negative pressure that just hit the market all at once, creating a selling cascade that completely overwhelmed anyone trying to buy. Let's break down these 4 key factors. First up, you had coordinated selling by the big institutions. Second, a massive outflow of cash from crypto ETFs. Third, some political drama was rattling global markets. And finally, a crisis for the very people who secure the network, the miners. You know, unlike past crashes that were mostly driven by smaller investors, this one, it felt different. It really looks like large institutions were selling in what you could call a coordinated campaign. Instead of balancing each other out, they all seemed to rush for the exit at once, creating this immense downward pressure. And here's the ironic part. The very financial products that were supposed to bring stability to the market, these exchange-traded funds or ETFs, they became a huge source of selling pressure. A whopping $3.4 billion flowed out in a single month. And as investors pulled their money out, those funds were forced to sell their Bitcoin, which just added more fuel to the fire. Then a shockwave from Washington. A surprise, pretty controversial nomination for the head of the U.S. Federal Reserve spooked markets all over the world. And when big investors get scared, what do? They sell their riskiest assets first. And right now, that's crypto. And finally, this falling price created what's basically a death spiral for miners. See, mining Bitcoin is super expensive. Suddenly, the rewards for mining just weren't enough to cover their massive electricity and hardware costs. This forced them to sell the Bitcoin they were holding, which, you guessed it, added even more selling pressure and pushed the price down even further. But look, it's not just about today's market pressures. There's a deeper, more futuristic fear that's quietly rattling the very foundations of crypto itself. It's called the quantum threat. The idea here is pretty simple, but honestly, it's terrifying. The entire security of Bitcoin relies on cryptographic encryption that is, right now, impossible for even the world's best supercomputers to break. But quantum computers, they're a whole new kind of machine. And theoretically, they could one day be powerful enough to just crack that encryption wide open. And the fear isn't just about someone stealing from your active wallet. The real, existential threat is someone hacking the millions of so-called lost wallets. You know, the ones where the keys are gone forever and the coins are supposed to be out of reach for good. And what's the ultimate doomsday scenario? Cracking the wallet of Bitcoin's anonymous creator, Satoshi Nakamoto. It's believed to hold over 1 million dormant coins. If a quantum computer could get in there and dump that entire supply on the market, it could crash the price to near zero, overnight. Okay, so as dramatic and scary as all of that sounds, it's really important that we zoom out. Because this is hardly the first time the world has declared that Bitcoin is dead. The crypto world is just littered with tombstones of past crashes. You had the infamous Mt. Gox collapse back in 2014, the brutal 80% bear market of 2018, and another 70% plunge in 2022. Drops of 50, 70, even 80% are, believe it or not, kind of part of Bitcoin's history. Now, consider this number for a second, 462. That is how many times major publications have written an obituary for Bitcoin. And yet, after every single one of those crashes, if you look at the historical data, within about 3 years, Bitcoin has not only recovered, but has gone on to set a brand new all-time high. So this all brings us to the big question, right? How should anyone even think about this market right now? Well, analysis suggests there are really 2 main mindsets. On one side, you have the long-term investor. This person believes in the fundamentals and just systematically buys the dips. Then, you've got the short-term trader. who kind of ignores the long-term story and is just waiting for a clear signal that a bottom is in before making a move.
But regardless of which camp you're in, there seem to be 3 golden rules for surviving a market this wild. 1, secure your assets in your own hardware wallet, not on an exchange that could go belly up. 2, manage your